Good afternoon. This is Laura Mattia and Steve Craven here to talk to you today about your smarter money. And as promised, we would like to continue our bond discussion and the role of bonds in your portfolio. We've discussed how important it is to be crystal clear on why you hold anything in your portfolio, whether it's bonds or equity. We've discussed with you specifically the role of bonds in your portfolio, which we talked to you about having diversity away from the market, dampening the volatility and creating smoother returns, providing a pool of funds to access if you need money in an emergency, and also to contribute to return more than cash or a money market fund. But again, we continue to evaluate things. And as we process what the Federal Reserve has been doing around the current economic environment and how it's impacting the overall yield curve, which we talked about in our first video on bonds, which we called Bond Part 1, it seems wise to continue our discussion around the risk associated with investing in bonds. So I guess, Steve, we can go to our kind of agenda slide. But as we talk about this, I just want to remind everybody, because I don't think we talk about this enough, that we really do have an expertise in the area of bonds. We spend time shopping for bonds specifically to meet your portfolio, and that really is a unique skill that we have. A lot of small types of boutique investing firms like ours just don't have the expertise. They often will use just bond funds because they don't know how to do what we're doing. And then the larger firms, such as the Goldman Sachs and the Merrill Lynch's, the companies that are actually market makers, they don't shop for bonds for your portfolio. They just give you what's in their inventory, whether it's good or bad. And there's a whole conflict of interest there that we could go on and talk about. It's actually a very frustrating thing because this is really the question of whether somebody's operating in your best interest or in the best interest of the shareholders.
I want to mention that one of the reasons why we don't have to use bond funds is because of it's basically because of our approach in terms of what types of bonds we purchase. If you're using a bond fund, you're doing it in part to achieve diversification and reduce the individual risk on your total position from each individual holding. And so if you're going to invest in corporate bonds, you want to be broadly diversified among corporations, even the safest corporations. Whereas if you're not buying corporate bonds and high yield bonds and things that become very risky during what we call risk on regimes like we just experienced due to the pandemic, you don't have to necessarily buy a bond fund. So in our case, we're using things that are inherently or have a very, very low risk inherently because of the types of bonds we purchase. That includes municipals, government agencies, CDs, debt that has been historically very, very safe. For example, municipals have had a default rate of about 0.01% going back to the last 75 years, for example.
And I love our ability to not just use what's at TD Ameritrade, but to actually shop at the bond houses. And these bond houses are not holding inventory saying, oh, this is what we have. We're telling them what our client profile looks like, what we need, and they're going out and helping us shop for those bonds. They're not just giving us whatever they have.
And that's an important point. So we use firms that are not market makers. A firm that's a market maker will typically be approached by a municipality, for example, or some other entity that needs to borrow money.
Well, they're on both sides of the deal, right?
That's correct. They'll float that bond issue, and they'll have that in their inventory, and so they have to find customers to purchase those bonds, and that's how they make that market for that entity that needs to borrow money. We don't use bond houses like that, so they don't have that conflict of interest. They're going to look for the best bonds what they feel are the best bonds are available on the market at the time we make the order, rather than use something out of their inventory.
And this is the difference between working with a 100% fiduciary who is a fiduciary to a client, or working with somebody that's a fiduciary to their shareholders. um, but we're digressing a little, but it's an area of concern for us. Today, we want to talk about really bonds, and we talked about the first risk that we are always addressing when we're purchasing a bond, and that is credit risk or default risk. We talk about that in, again, that bond part 1 video that we created. But today we want to talk about the second risk that we address, and that is something called interest rate risk. There are a variety of other risks associated with bond investing as well, but right now we're going to focus on interest rate risk, which can be a temporary loss, or it could be a permanent loss in your portfolio, depending upon what's going on. If you're in a fund, it could be a permanent loss. If you're in a bond that you're holding to maturity, it might just be a temporary loss on paper, but it could come back. We then want to talk about the right way to protect against that risk. And one way is using short duration bonds, and then also talk about the wrong way to protect. There is a lure of investing in floating rate bond funds and what the problem is with that. So first, I guess it's really important to understand how bonds are constructed and how they are valued, because that really will help paint the picture.
You're going to talk about the key drivers that determine the value of a bond.
Right. And so a bond has, along with it, it's a contract that is created with an issuer, whether it's a government agency or a corporation or whatever type of organization is looking to borrow money. They create this contract. And there are 3 elements of that contract. They're going to tell you how much money they want to borrow, and they'll pay you back. So, for example, they'll say, we want to borrow $1,000, and we're going to pay you back at a certain time, and that is the maturity time. It's the length of time that they're going to borrow that money for. And so let's say it's for 5 years. And really, when we're talking about short duration, that is the maximum really that you're usually looking for under 5 years, possibly under 7 years, right, Steve?
Yeah, and I want to mention that, a lot of bonds will go out to 30 years, but it's been our experience that there's little gain in buying a bond that has a maturity that's 30 years in the future. Typically, we think that going any more than 10 to 12 years is probably the most or the furthest you want to go out in time. And there's an interesting reason for that, which we can discuss in another video possibly. The yield curve, which is the time versus interest rate relationship that's plotted on a graph, the yield curve is typically upward sloping. In other words, the interest rate is higher for the longer amount of time you're willing to commit the money. But what happens is the yield curve typically tends to level off. So once you get out to 10 or 12 years, you're not getting a lot of additional yield by going out to 30 years. So it doesn't typically make a lot of sense.
And that's in the current environment. If we were in 2008...
I mention one caveat to that, Laura, is that if you'd bought 30-year treasuries in 1980, you might have beaten the stock market, actually.
Yeah, that was a great time to buy long-term bonds. And we know from those people that retired at that time, they've pretty much lived on those bonds, and that was great for them. But okay, so we have the par value. Can we just go back for a second?
Sure,
We have the par value, we have the maturity, and then we have the coupon interest rate. And the coupon interest rate is today, if we go out and look at every issuance in the quality type of bond that we're offering, the quality and the type and a couple of various parameters, they're all offering 2%. So that's what we have to offer is 2%. And so that means we're going to pay you 2% of that par value, which is $20 every year for the next 5 years. It doesn't change. It is the coupon interest rate. It only has to do with what the market interest rate is at the time that contract is created. If interest rates go up or down next year, it doesn't matter. We're just going to stick to that 2% or $20 a year. And so that's an important, that coupon interest rate, people get confused with the coupon interest rate and the market interest rate. Those are two separate things. The coupon interest rate just sets the amount that the issuer is going to pay you.
Yep.
So what really you're getting from a bond is you're getting an annuity stream of $20 for the next 5 years, and then you're getting a single payment back of $1,000 for your initial $1,000 that you gave them. And when we value a bond, this might seem a little bit complicated, but it isn't as complicated as it looks. What we're doing is we're looking at the current value, or we call it the present value, of $20 for 5 years, and we discount that back to the current time. So you can hit the space bar, Steve. And
by the
then,
way, most bonds pay in fact, I think almost all bonds pay semi-annually.
yes. Unless it's a zero coupon, but that's a whole nother vehicle.
That's correct.
So in the 5th year, you get that $20, but you also get that $1,000 back. So the value of that bond is the value of the discounted cash flows. And as long as the discount rate, the market interest rate is 2%, the value of the bond is $1,000 and everything is equal. So when we look at the value of bonds, they change based upon the interest rate. The next slide shows how the value of the bond at a 2% market will be $1,000. But now what happens if the interest rate changes?
So the way that works is there are multiple yield curves, by the way, not just one. Yield curves apply to different quality of bonds, different types of bonds. And so what Laura's saying is, what happens if the interest rate that's required to invest in that type of bond with that credit rating changes? For example, what happens if it drops from 2% to 1% in the yield curve?
And that's actually what we've experienced over, as Steve alluded to, the past 40 years, as interest rates were so high in the 80s and have been coming down, 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 down. Every time in the market interest rates came down and you were holding a bond that had a higher coupon rate, you actually had a bond that was worth more money than you initially paid for it. You could sell it at a premium. And so that's what happens, is that if a bond fund is holding bonds and interest rates go down, everything's great. But the bonds in those bond funds are at a premium. And if they want to sell them, if people come into their fund or leave their fund, it doesn't matter. They can sell those bonds and they look like heroes because they're able to ride that lower interest rate and actually that higher valuation.
And by the way, if you're holding this individual bond, you may decide that even though you're getting a higher net yield on your original investment than the current market, you might decide that, gee, I really want to take my profit and run, although you won't be able to reinvest those proceeds with the same yield. You're now going to have to accept a 1% yield.
Right. Steve's alluding to a third kind of risk called the reinvestment risk, which we could talk about on another video. But okay, so now what happens when interest rates go up? When the issuer issued the bond, they said, we're going to pay at 2%. And so that's what you're getting is 2%. But now the market for new issuance are paying 3%. Well, in order to be competitive, in order for you to sell that bond in the marketplace, you need to discount that bond value so that you're competitive. And so the actual value of the bond comes down. This creates a big problem for bond funds because now what they see is people are now rushing out of their fund, trying to redeem their money, and they're forced to lock in this loss. If you're holding an individual bond and it goes down in value like this, you can say, you know what? I don't care that it went down in value. I know in 5 years that issuer has to pay me $1,000, regardless of what happened to the value in between. And that's one of the great things about holding an individual bond is we're in control. We can decide whether we're going to sell or not.
I want to mention one thing. Notice the unsymmetrical effect of interest rates. A 1% decrease in rates on this bond led to a $50 increase in value, whereas a 1% increase in interest rates here led to a $43 decline, which is an interesting feature to individual bonds.
Yes. So that's probably more complicated than we want to explain, right, Steve?
No, we're not going to explain it now.
Okay.
I think
Okay.
that's a great topic, possibly for another future video. Why that
Yes. Okay. So we have this problem with interest rates, and we don't want to necessarily get stuck holding bonds that have this potential interest rate exposure. Because when the interest rates go up, the value of the bonds go down. And when the interest rates go down, but the actual bond value goes up. And that's what is all on this crazy slide, which, Steve, if you want to play with that animation.
Sure. I want to mention too about bond mutual funds and ETFs. As Laura mentioned, she was alluding to, what happens is the net asset value of those types of investments, I think I rolled it back, will decline potentially if interest rates rise. So you may not actually have a loss unless you sell, but you may have to wait for an entire interest rate cycle for interest rates to actually go down again for you to recover your net asset value. But you may never recover, because it's also possible, like as Laura said, there could have been liquidations and the fund could have taken losses internally within the fund, and that net asset value may be lower permanently. So it's something to consider.
Right. So we wanted to talk a little bit about the strategy around individual bonds, and one of the ways that you can guard against the risk of interest rate is, just simply buying a bond and holding to maturity, and that way that you have a contractual agreement with that issuer that you're going to get your money back. But there's different strategies to holding individual bonds to generate. We look for total return always. We're not going to necessarily get too much into that, but the short duration bonds do seem like an appropriate place to be right now. And I want to say a couple of things. I've been following some of this stuff, Steve. It seems like a tremendous amount of money has actually left the equity and fixed income arena recently. That I think I was reading somewhere yesterday that there's about $5 trillion sitting in money market funds, which of course money market funds are paying pretty much close to zero. So we know there's a lot of money in money market funds. We know that the Fed had last week again committed to keeping interest rates low for pretty much at least the near future.
2022, I believe they said.
Right. So that commitment could absolutely start creating a lot more demand for this shorter duration bond area, right?
Yep.
The other thing is since March, and actually if you flip the chart to the next slide, sure. We pulled this off of, again, the Federal Reserve's database here. And it seems that since March, for one of the very few times, it doesn't happen that often, but it seems that these shorter duration bonds are really much more favorable than the actual federal funds rate. This slide shows the difference, the spread between the federal funds rate and
almost zero.
Right. But for a long time, it was actually, the gap was actually negative, and it did go positive a little bit for a few years, but this is actually the most positive it's been in a while. So we are getting this extra spread, and that could be another thing that compels more investors that are in money markets to at least explore into the short duration bonds.
So I believe a lot of that money that's in money market funds came out of equity and also corporate bonds and a lot of other assets that really suffered during this risk-on environment due to the pandemic, which began in February, actually.
Right. And so, in terms of short-term bonds versus money markets, you can start doing the math and figuring out which one would be better for individual investors. We like shorter term duration fixed income for a variety of reasons, but really when we look at it, we're looking at it for kind of a couple of different reasons. We want the protection against interest rates foremost. We want to preserve your capital. We may also be looking for some income for you as well. And this fits really nicely into our cash buckets, into our three buckets, and making sure that there's always some funds that we can access that are doing okay. And I believe, Steve, that even at the worst of time this year, our short-term bonds were in the favorable range, correct?
All of our bonds pretty much held their value. And actually, a lot of our bonds increased in value because of the drop in interest rates. So the bond portion of our clients' portfolios has been very, very stable. And it's been a great source of stability in their portfolios this year. And by the way, I want to mention that there is a trade-off between holding money in the money market where interest rates could be low for the next 2 years, according to the Federal Reserve, versus possibly buying some bonds and at least earning 1% on your money. So we need to consider that trade-off and examine it and maybe do a bit of an analysis. And what we do have a Bloomberg terminal, so we can look at what the hypothetical return of a bond is over various interest rate scenarios. So it may make sense even to buy a 3 or 4 year bond, even if interest rates go up 50 basis points or 100 basis points over the next year or two, you may still come out way ahead on that 3 or 4 year bond versus earning almost nothing in a money market account. So it's something to consider.
Even a CD, right, Steve?
That's correct.
And,
yes.
I like our CDs because we're able to trade them on the market as well without taking a penalty. So we're not necessarily locked into you must hold this for 2 or 3 years if we don't want to hold it.
And they're very low risk. I will never say that anything is riskless. I wouldn't even call a treasury riskless, even though in the world of finance it's considered to be a riskless asset. I'm always really cautious about calling anything riskless.
Right. But again, this slide actually just talks to why are we holding this asset in your portfolio? Always, again, a question to ask. Anytime you see something in your portfolio, what does this particular asset class buy me? Why do I hold this? What is its role in my portfolio? Always important to go back and look at. Which brings us to, I guess, our final points, and that is we have been somewhat harangued by a couple of folks wanting us to potentially go into this floating rate bond arena, and I'm so thankful that we stuck to our guns and said no, we're not going to go there because none of them have done well. This is actually a list of, I think, the top 20 floating rate bond funds, and they performed anywhere from a negative 0.4 or negative 40 basis points to a negative 17. Which, and they also charge fairly high expense ratios too. I was surprised when I started looking at these funds, their expense ratios could be in the neighborhood of 1.6%. So
that's because they're actually servicing loans, which has a high cost to it associated with it. And
right.
By the way, these returns that Laura shows here are 1 year returns through June 5th. They really don't show the dramatic impact the risk on regime that we're in now in the markets, which began on February 3rd, have had on these floating rate bond funds. All of this negative return came about beginning February 23rd. So the actual short-term return on these over the last 4 months is even far more negative.
Right. And that's because we know these bonds have left tail correlation risk, right? We know that. And the reason why is because of what they represent. So let's just talk about what they represent. And why people are lured into that, because they're sold on the fact that, oh, these coupon rates can periodically reset. And so you're
You get
going
a
to be
5 or
able to
6% return in a 2% yield environment.
Right. So you're compelled to go into them because they have this varying interest rate. You get to ride it up, ride it down. It gives you more flexibility in terms of interest rate, income risk. It can include all kinds of different bonds, corporate bonds, preferred stock. Um, it and it even includes these repos and other kinds of loans that banks can offer. But usually these funds are creating, or they're chasing yields is what they're
They're,
doing.
they're making loans to companies that may not have ready access to the credit markets because they're companies that are really not in the best shape. And so these are high risk loans. This one brings me back to something I'll never forget. When I was getting my master's in finance at Rutgers years ago, we had his professor. His name was Dr. Nadler, who was a phenomenal professor. And he taught economics and some banking courses. And he wrote these letters on the blackboard: TINSTAAFL. And that's all he wrote on the blackboard. And we were saying to ourselves, what the heck does that mean? And finally, he said what it means. There is no such thing as a free lunch. And when you see anything that's promising a high yield, there is risk there that may not be obvious, but that risk exists. Otherwise, it would be priced at 1 or 2% yield if that risk did not exist. You just may not see that risk because it may not have reared its head over the last 7 or 8 years. But suddenly, and in the case with these floating rate bond funds, by the way, the last time we saw this decline was in 2008. So it was almost a 12-year interval before you saw that again.
Mm-hmm. I love that story, Steve. It's so true, because the thing is that the people that you're dealing with, when anybody comes and tells you there's a business or there's a project or there's something where they're willing to pay an interest rate that's higher than what the market would bear, there's a reason why they're willing to pay an interest rate higher than what the market would bear. Why would they do that? If they could get access to money at a cheaper rate, these are smart people. They would access the money at a cheaper rate. So the reason why they're paying that high rate is because there's a problem. There's some kind of distress associated with that project or that corporation or that firm, whatever the entity is. So yes, buyer beware.
Always remember a corporation that has a fiduciary duty to their shareholders. They don't necessarily have that duty to their credit holders. And so what they're going to do is typically going to be in the best interest of the shareholders, not the people from whom they borrowed money from. And that's an important point as well. So when you're dealing with corporate debt, floating rate loans are really just a form of corporate debt, but they're loans, they're not bonds. You're dealing with a company that cares, or an entity really cares more about its shareholders than the people holding that debt. That's always important to remember.
So I think we've probably given you enough information to know why we choose to hold these particular vehicles in your portfolio. If you have questions about this and you want to discuss it more, please let us know. We will probably do a bond part 3 section, because we can go on.
I have topics for that.
I know you do.
We'll talk about topics that'll probably make everyone's eyes glaze over, including yield to maturity. Well, we mentioned that a bit. Yield to call, yield to worst, and duration possibly.
Yeah, and why we also like premium bonds.
Yes,
even to buy premium bonds. Don't forget, again, we don't always buy the first issuance. We also buy sometimes off of the secondary market, and there's opportunity there. So yes, there's a lot of topics that we can talk about in this.
We promise not to talk about convexity, though.
Yeah, that would definitely make people's heads spin. Okay, so again, we believe it's really important to understand your risk exposure with everything that you own in your portfolio. We are happy to be able to help you understand what your risk exposure is, and really, again, it's a pleasure to serve all of you, and we look forward to seeing you at our next video. After all, It's your smarter money.